Hi there. In this video, I will continue talking about the partnerships. In the previous video, I talked about starting a partnership and distribution of income. We covered all the journal entries when the company starts and at the end of every year when they distribute the income or losses. In this video, I'm going to talk about the termination and liquidation. Specifically, I will talk about the deficit of one of the partners and the pre-distribution plan. What do we mean by deficit of a partner? It means his capital balance is turning out to be negative. And we might wonder what are the reasons for this negative capital balance. Number one, the company might be insolvent at the beginning of the liquidation, which means doesn't have enough cash to cover up all the due payments. Or the company might have done some big losses from selling the non-cash assets. At the liquidation time, the company usually sells all the inventory, accounts receivable, all the fixed assets. And at this transaction of selling the non-cash assets, the company might make big losses. Because of those reasons, one or more of the capital accounts of the partner might turn out to be negative. And the result for that maybe the company will not be able to pay the creditors, the liabilities, or the company might not be able to pay all the capital balances for the partners, which we call it negative capital account. So what are the consequences of this deficit capital balance? One of two reasons might happen. First, the deficient partner might pay his deficit out of his own personal cash, or the remaining partners might absorb this deficit balance from their own capital balances. So let us have an example to go through one situation at the liquidation where a company here has three partners, Holland, Dozier, and Ross. As you can see that Holland here has deficit of 6,000, and we need to know how it will be covered. First of all, we see if Holland can cover it by himself or the other two partners can cover up this loss. So the payment by the deficient partner, which is Holland, Holland will pay cash 6,000, and consequently his capital balance will be increased by 6,000 to offset the negative balance, and then his capital will be zero. Then the remaining cash, which means 20,000 from the beginning, plus the 6,000 that has been paid by Holland, will cover up the capital balances of Dozier and Ross. So this is one situation. What will happen if Holland refuses to pay all the capital balances? Then Dozier and Ross will cover it up out of their own balance. So their capital balances will be debit, as you can see here, 4,000 for Dozier, 2,000 from Ross, and Holland will have a positive capital balance of 6 that will offset the negative 1, and his balance will be 0. Then Dozier and Ross will take the remaining, which you can notice here that the capital balance that have been left over for Dozier and Ross is less than what it should be. So this is the first point at the termination or liquidation, is how to cover up the deficit, either by deficient partner or by the remaining partners. The second point we need to talk about in this video is the pre-distribution plan. What do we mean by pre-distribution plan? We make a situation or a simulation where we assume what will happen if the company incur several losses during the time of the liquidation. And these losses might eliminate one or more of the partner's capital account. So the difference between deficit capital balance, which I mentioned recently, and the pre-distribution plan is the amount of losses in the pre-distribution plan is much more than the amount of losses for deficient partners. Then what shall we do? We should make a plan, and this plan will work as a guide for our future pay. So let us take a look on this exercise where we see here three partners, Robbins, Smith, and Price. And here is their capital balances are positive, and their income loss ratio 50, 20, and 30%. The liabilities here are 100,000. The non-cash assets 221, which we assume it might be sold for huge loss. And at the time of liquidation, the company is going to have 12,000 as liquidating expenses. What shall we do? If selling the non-cash assets is generating lots of losses, first of all, we need to assume how much loss can be absorbed by Robbins, then Smith, then Price. To do that, we make something, we call it sensitivity for losses. So here we put the maximum loss of partners based on their capital balance. So for example, let us take Robbins. His capital balance is 30,000. His income loss ratio, 50%. If we divide 30,000 by 50%, we get 60,000. What does it mean? If the company made $60,000 loss, Robbins can take up to 50% of this loss, which will eat up all his capital, and his capital will become zero. So I calculated the maximum loss based on his income loss ratio and his capital balance. Then we do the same for Smith. His capital balance 40,000, his income loss ratio 20%, divide 40,000 by 20%, we get 200,000. And finally, we do the same for Price. We divide his capital balance by his income loss ratio, we get the maximum loss. Now, we need to look at the maximum loss by their amounts. So the smallest one is Robbins, the second one, Price, the third one, Smith. And based on that, I'm going to make a pre-distribution plan starting by the smallest amount of loss, which is 60,000. So here we see their beginning capital, 30, 40, 51. And we assume the loss that might happen from selling the non-cash asset, 60,000. Multiplied by 50%, we get Robbins capital 0. Then Smith is going to take 12. Price will get 18. So the new capital balance for Smith is 28 and Price 33. If you remember from the previous slide, the second one that comes after Robbins is Price, that the maximum loss that he can take is 170. So now we have Smith new capital balance 28 and Price 33. We should come up with ratio between them, which is 20 without the percent and 30 without the percent. Why did I remove the percent? Because Robbins doesn't exist anymore. So we take the ratio by 20 to 30, which means 2 to 5 and 3 to 5. So we take 33, and why I take 33? Because in the sensitivity analysis, Price comes after Robbins. So we take 33 divided by the 3 over 5, which means 60%. And here we get Price 33 by minus, and then Smith 22 by minus. So their total is 55. So now Price balance became 0, and Smith new capital is 6. Then we generate loss of 6,000, so Smith capital will be 0. So Here we make the pre-distribution plan based on the amount of losses that might happen. And finally, we assume if the company is going to generate cash from selling the non-cash assets, first of all, it will go to the liabilities and the liquidating expenses. If you remember, the liabilities were 100,000, the liquidating expenses 12. So the first amount that we get from selling the non-cash assets will go to those two categories, which means 112 will be paid for both of them. What will happen if the company get more money on selling the non-cash assets? It will go to Smith, 6,000. If they get more money, they will distribute it between Smith and Trice. If they get more money, they split it between Robbins, Smith, and Trice. So this is what we usually do at the liquidation time if we have deficit in the capital balance or we have huge losses that should be distributed among the partners. I hope you find this video useful. Thank you. Bye-bye.